Good afternoon. I'm just going to hand out a piece of paper and then I'll be right back to the desk. We're starting with learning objective number 3 or class goals number 3 from the last handout chapter or handout 13, chapter 11. This will be our project for later. I was one short, but she's online, so we're good. Okay, so we are using the same sheet. I do have a couple left if somebody forgot one and they need one. Not, we're going to get started and we're going to talk about goodwill. So goodwill can only be recorded in the case of a business purchase. Goodwill equals the difference between the purchase price and the fair value of assets acquired in the purchase. Now, why would somebody pay more than the fair value of assets for a company? Whoever's selling wants to make a profit, sure. Why would you buy it though? If you saw the fair value of the assets is only $100 million, why would you pay 120? Right. Right. So we're talking about intangible assets. There are things that we can't really put on the books that can be tied to a company. Most of it is generally tied to human capital and the expectations and how you can manage that in the future. The one thing we can't do is we can't put the value of a person on our books, but we have seen how valuable people can be. Now, how do we see that? What kind of measures, what investors think about people in the specific companies? Stock price, right? So years ago with Apple, Steve Jobs' health was failing. And basically, they knew that if he was gone from the company, it would actually end up reducing the stock price. And so it was actually thought that he was worth about $8 billion in stock price at that time. Now, Apple's a multi-billion-dollar company, but that's still a really big value. And you can't put a price on that. Now, things like customer lists, those you can put a price on. Things like the name, you can put a price on. Reputation, that's very hard. So there are things there that you say, we can do more with this than what they're doing, and so we're willing to recognize it. So that goodwill becomes part of what you can't really put your finger on exactly and say, this asset is something that I'm gaining because of it. And so essentially all of that goes into goodwill. And so for example 1, if we assume that it was a business purchase. We have, oh, it didn't copy down for me. Excuse me. This is just what we had before. So at the time, we said, you know, there was no goodwill here, was zero because we bought some assets. We didn't buy a business. But if we assume it was a business purchase, then the goodwill would be 10,000. And so what we would do is make an entry, debit patents for 16,000, debit trademarks for 20,000, debit copyright for 44,000, debit goodwill for 10,000. And then you would credit however you paid for it. I think they said cash, 90,000. And so remember, we said the fair value of the assets was 80. In a business combination, we can record the goodwill and we will record the goodwill. Goodwill is not amortized, but we do have to check the value annually for impairment. Any questions? Let's take a look at example 4, and I will walk you through that. Okay. So we have our purchase price, and that's 2.4 million. And the book value of Hager Company's net assets is 1.86 million. And to get it to the adjustment to fair value, it says indicates the fair value of Hager's tangible assets exceeds the book value by 180,000. And the adjustment to fair value so this one was for identifiable intangible assets and tangible assets. So this is the fair value for the tangible. Sorry, I'm gonna move all this over. And then the fair value of intangible, 135,000. And so all they're doing is saying, here's the book value. How do we get to the fair value? And so they're just telling you related to the book value. Normally you wouldn't care about the book value, but because it's given in this way, we have to use it. And so our total fair value equals, we add those three numbers up, and we end up with 2,175,000. Let me just check my math on that. So the purchase price exceeds fair value by 225,000. So we take the 2.4 million, subtract the 2.175 and we get 225,000, which is going to be the goodwill. And so the answer is D. Any questions there? Okay. Let's look at example 5. Take a few 30 seconds to read it, and then I'll go through it. Okay, so we're trying to find the amount of goodwill again in the acquisition. And so we take the purchase price. Whenever I drink coffee, I'm always like, few S's, a few extra letters in there. I apologize. That's 820,000. And then it says, okay, Barlow's balance sheet showed assets of 610,000, liabilities of 240,000, and owner's equity of 420,000. So the fair value of assets equals $970,000, but we have to deduct the fair value of debt, which is 240,000. And so our net fair value is 730,000. So the purchase price exceeds fair value of assets by 90,000. And so that would equal goodwill. Any questions? Okay, let's take a look at example 6 before we jump into a couple practice ones. I'll walk you through this. Okay, so it says bond company purchased the net assets of May company and for 2.2 million on the date of the transaction, May had 600,000 of liabilities. The fair value of May's assets were acquired were as follows: current and non-current total 3.6 million. So we have a purchase price of 3.6 million. And then we have to calculate our net fair value, so the fair value of assets. 3.6 million. Nope, no, that was not the purchase price. I'm sorry. Somebody should correct me on that. That's 2.2 million. Sorry. Told you that coffee gets me. That's why I went with tea this time, but. Nope. Occasionally I make those mistakes. And then you have to subtract the fair value of liabilities. And so they said that was 600,000. So the net fair value is 3 million. And so the fair value of the assets is greater than the purchase price. So the difference, 800,000, is recorded as a gain. And so that's B. Okay, so let's have you guys try practice number 3. And I'll give you like 3 or 4 minutes and check back where you are. Alrighty. Okay, so it says Dennis Company purchases Miles Company for $5 million cash. The book value of the company assets reported was 3.6 million. An analysis indicated the fair value of the tangible assets exceeded book value by 600,000, and the fair value of identifiable intangible assets exceeded book value by 320,000. Determine the fair value of the identifiable net assets. So we have book value of assets, and that was 3.6 million. And then we have fair value adjustment for tangible, 600,000. And then the fair value adjustment for intangible equals 320,000. And so the fair value of identifiable net assets equals, I get 4,520,000 or B. Okay, any questions there? If not, we can go on to practice 4 and wrap up chapter 11. Okay, let's go ahead and take a look at practice number 4. We have what we're trying to find. What amount of gain or goodwill is recognized by the purchasing company? So we have purchase price, and that's 4.2 million. And then we have book value of assets, 4.2 million. And then we have the adjustment for tangible, and that's 600,000. Intangible, and that's 320,000. So the net fair value, I get 5.120 million. And so the difference, purchase price less than fair value, equals a gain of 920,000. I was working on that in my office earlier, and I made a math mistake, and I couldn't find any of the answers. And like I kept looking at it, and it was simple, but sometimes even on those simple ones, you got to use a calculator for it because you just miss things in your brain. And even when you go back and look at it again, you're like, oh, how did I make that mistake? Any questions? Okay, so we've covered the challenging stuff in the chapter. There's still a part 4 that's relatively straightforward. And what we're going to do now is focus on the team problem. And so you guys can work as a large group or 2 small groups, however you prefer. Those of you online, there are 2 of you. If you want to message each other and work together or chat in the group, you should be able to do that. And I want to just pull up the problem. It should be available in our Canvas site. And so we have the group problem for chapter 11. And it says October 29th, but I'm going to edit that. And it is going to be due, today being the 17th, it'll be Tuesday the 22nd. Okay. Now you have a copy of this for those of you who are here. For those of you that don't, you can just download this copy and work on that, and you can upload it either in Excel or in the document format, whatever you prefer. All right, one thing I want to tell you is that this has some kind of extra information, and so don't get too caught up in this. You don't really need to go out to Appendix 18A. We're just treating it, the franchise, like an intangible asset. So basically what we want to know here in this part is the 3 assets that you've got. Oh, I can't adjust this one. Give me 1 second. So we just want to know the 3 assets. So you have franchise, and you can sort of say, okay, see Schedule 1. And what we want to know is the net or carrying value at 12/31/2025 for the franchise, and then the patent, Schedule 2, and then Schedule 3 for the trademark. And then you're just going to put the net value over there. And you're going to use each of the schedules to calculate that value. Now, the schedules have more lines than what the textbook shows you need. But really, we've got to just figure out, think of these like long-term assets, right? If I was asking you to find the book value or carrying value of long-term assets that are tangible, you would just give me what was the historical cost less my depreciation. So all you're doing here is saying, what is my historical cost? What is my amortization? And remember, we don't have accumulated depreciation, so it's amortization is included in the asset value. Okay? Do you have any other questions, either on the chat or in the room? You can please ask me. I'm going to pause the recording and allow you guys to work on it.